5,000 on the S&P next year. Steve, can you walk me through this call when we're looking at deceleration from 21 to 22 on GDP, why we can carry on pushing to these kind of levels?
Well, Jonathan, that's why I put out the piece, because I think the general view on Wall Street is kind of bullish on this year, but then wait till next year. It's going to be all turned bad again. And we just don't think that. I mean, if you just look at the trend rate of GDP growth and what we lost at a trend over the last few years, you'd have to grow 6 to 7% a year this year and next year just to get back to trend by the end of next year or getting close to it. And that doesn't count the 15% of GDP that's been thrown at this thing that mostly is still on the forest floor in the form of cash in corporates and in individuals. So, you know, we just think the numbers are so spectacular when you run them on the GDP growth side. No one wants to say it because it just sounds too crazy. And then when you factor that through into earnings growth, remember, S&P companies make money on nominal GDP. We're probably looking here at nominal GDP growth this year in the high single digits and probably similar to that next year. That can get your earnings on the S&P well north of 200. And, you know, we think a fair multiple we've been using for some time now is around 22 times on that number. And, you know, you can get yourself up to 4,500, 5,000 pretty easily that way.